Welcome back to the deep dive. We're recording this in early 2026, and, well, I think we can all agree on one thing right out of the gate. The word stability has basically been retired from the dictionary. It feels like a relic.
It certainly does. I mean, if you're listening to this, you're likely feeling the vibrations. Between the cyber attacks that seem to hit the headlines weekly, trade wars that shift supply chains overnight, and a political landscape that, well, changes direction with the wind. Business as usual is a phrase from a bygone era.
It really is, and that volatility isn't just a headache for us reading the news, over our morning coffee. It's an existential crisis for the global financial system. Today, we're unpacking a massive report from McKinsey Company. It's dated December 2025, and it's titled The Future of Risk: How Global Trends Are Reshaping Risk Management.
Before you tune out because you heard risk management,
All right.
thinking this is all about insurance policies or compliance officers walking around with clipboards. Let me stop you. This report argues that risk management is no longer a back office function at all. It's becoming the absolute strategic nerve center of any financial institution that wants to survive the next decade.
That's the key shift here, isn't it? We're moving from defense to offense, or at least to active survival. So whether you're prepping for a boardroom showdown or you're just trying to figure out why the banking sector is pivoting so hard, this is your cheat sheet. We're going to explore the death of old school assurance, the rise of digital twins, and why your bank might soon be hiring more philosophers than accountants.
Philosophers who can code, maybe, but
Yeah.
yes, the scope is huge. It's about how institutions navigate a world that is fundamentally more dangerous than the one we built our systems for.
Okay, so let's start with the context. The report identifies five, what they call force multipliers. These are trends that are reshaping the landscape. And the first one is geopolitical flux. They drop a statistic here that it actually made me do a double take.
You're talking about the World Uncertainty Index.
Right. I mean, we all know the world is uncertain. We feel it every time we check our phones. But the data is startling.
It is. As of late 2025, the World Uncertainty Index is nearly 9 times higher than it was 20 years ago.
Wow.
Let that sink in for a second. 9 times the level of unpredictability compared to the early 2000s.
That's staggering.
Mhm.
And the implication there is that the old way of handling crises, the whole war room approach, that's dead. Right.
Completely obsolete. Think about the old model. A crisis happens, say, a massive tariff is announced, or a conflict breaks out in a key shipping lane. What happens? The bank executives rush into a conference room, they order pizzas, and stay up all night trying to figure out their exposure,
Right. They're pulling spreadsheets, calling regional managers.
trying to get a snapshot.
Yeah.
But by the time they have the answer, the market has already moved. It's just too slow.
The damage is done while they're waiting for the pepperoni pizza.
Exactly. In a world of 9x uncertainty, this geopolitical flux is the new normal. It disrupts capital flows, supply chains, everything, instantly. You can't just react anymore. You need standing capabilities. Agile teams that are always monitoring, always simulating.
It's the difference between a fire department waiting for a call and a fire suppression system that just activates instantly.
That's a great analogy.
Which segues perfectly into the second trend, technological velocity. This feels like the classic double-edged sword. On one hand, everything's faster, easier for the consumer. On the other,
Everything is faster and easier for the bad guys. Precisely. Digitalization has reshaped everything. I mean, think about how easy it is to open an account now compared to 10 years ago. But it also means risk travels at the speed of light. We talk about contagion in banking.
the idea that if one bank fails, the next one gets sick.
Exactly. In the old days, that took weeks to spread. Rumors had to travel. People had to physically line up at branches.
No, it happens in minutes. Everyone can pull their deposits on an app from their couch.
It's the standard reality now. And it's not just the speed. It's the nature of the threat. AI is rewriting the fraud landscape. We aren't just dealing with someone stealing a credit card number anymore. We're dealing with AI-driven synthetic identities, deepfakes, automated attacks that can hit a system thousands of times a second.
It's an arms race. The banks get better armor, the hackers get better missiles, and that connects to the third trend, which I found the most unnerving, the interconnected web. The report describes this ripple effect, where a problem in one corner of the world just breaks something halfway across the globe.
This is the butterfly effect for money. Let's trace a path, right?
Yeah.
A geopolitical event disrupts the supply chain in Southeast Asia.
Yeah.
That disruption ruins the credit quality of a major manufacturer in Germany because they can't get parts. That drop in credit quality causes a spike in bond yields in New York. It's all one organism now.
And this introduces a term I had not heard before, nth-party risk. I know third-party risk worrying about your vendors. the nth party.
This is the monster in the closet. Financial institutions rely on technology providers, cloud services, payment processors, but those providers rely on other providers who rely on other providers. That's your fourth, fifth, nth party.
So I might have vetted my vendor, and they're solid, but I have no idea who their vendor's vendor is.
Exactly. And here's the nightmare scenario. What if, deep down in that chain, there's one obscure data center or some open source software library that everyone relies on without even realizing it?
Oh, wow.
If that one node fails, it doesn't just hurt one bank, it could take down the whole ecosystem. It's a concentration of risk that's basically invisible until it snaps.
That is terrifying. It's like discovering the entire electrical grid runs on a single extension cord in a basement somewhere.
A very fragile extension cord that nobody is inspecting.
Okay, moving to the fourth trend. This one sounds like a conspiracy thriller. The shadow banks.
It does sound dramatic, doesn't it? But shadow banks is just the industry term for non-bank financial institutions, or NBFIs. These are entities that provide financial services lending, asset management, private credit, but they don't hold a banking license.
And the report drops a bombshell statistic here about how much money is actually in these shadows.
It's massive. In the United States, NBFIs now hold almost 80% of financial assets.
Wait, 80%? So the traditional banks, the big stone buildings on the corners, they're the minority.
In terms of holding financial assets, yes. And even globally, in advanced economies, it's over 50%. The center of gravity is shifted.
Why does that matter for risk?
Because NBFIs are generally less regulated. They don't have the same capital requirements, the same liquidity rules or transparency mandates. So what we're seeing is counterparty risk.
Right.
The risk that the person on the other side of your deal can't pay. It's shifting out of the highly regulated, visible banking sector and into this opaque, less regulated space.
So the risk hasn't disappeared, it's just moved to a neighborhood where the police patrol less often.
That is a perfect way to put it. And when you add digital assets and crypto into that mix, you have a massive headache for things like anti-money laundering controls.
The money is harder to track.
And the entities holding it are less transparent.
Which brings us to the final trend, regulatory fragmentation. You'd think, with all these global risks, the world would come together and agree on a rulebook.
You would hope so. Logic would dictate global coordination. But we're seeing the opposite.
We're seeing fragmentation.
Exactly. The report highlights that right now, the United States is pursuing deregulation at a pace that's just unmatched by other jurisdictions.
So the U.S. is loosening the reins while Europe or Asia might be tightening them.
Correct. And for a global firm, that is a logistical nightmare. You have to manage your legal entities differently everywhere you operate. It becomes incredibly complex to move capital or manage data when the rules of the game change every time you cross a border.
Okay, so to recap the force multipliers, the world is 9 times more uncertain. Tech is moving faster than we can think. Everything's interconnected by invisible parties. The money's hiding in shadow banks, and the regulators can't agree on the rules.
That is the state of play in 2026.
Comforting. So, given that chaos, the report pivots to the evolution. How do we manage this? They talk about concepts that need to die and concepts that need to be born. What's the biggest casualty here?
The biggest casualty is the concept of assurance through periodic sample testing.
Periodic sample testing? That sounds like the old audit model.
It is. The old way was once a quarter, maybe once a year, you take a sample of your loan files or your transaction data. You check, 5% of them?
And if they look good, you just assume the other 95% are fine.
You assume, and you sign off. You say, we have assurance.
And that's dead.
It has to be. In a world of real-time crises and AI fraud, looking at a sample of data from 3 months ago is worse than useless. It's dangerous. It gives you a false sense of security.
It's like checking your smoke alarm once a year while your kitchen is currently on fire.
A vivid analogy, but accurate. The replacement is continuous, real-time portfolio monitoring. They call it intervention by exception.
How does that work?
You don't check samples. The system checks everything, all the time, every transaction, every loan. The algorithms run 24/7. Humans only step in when the system flags an anomaly, an exception.
So the humans aren't the primary filter anymore.
No, the machine is the filter. The humans are the investigators. But it goes beyond just monitoring. The most exciting shift, I think, is the rise of digital twins.
I love this concept. It sounds like something out of NASA.
It's borrowed directly from engineering. In aerospace, you build a digital replica of a jet engine to test it before you build the real one. Banks are now doing this with their balance sheets.
So they have a virtual bank sitting inside a computer.
Effectively, yes. a full-scale digital replica of the institution's assets, liabilities, exposures. And this changes decision-making entirely. In the past, if a bank wanted to launch a new product, they'd use historical data to guess the risk. Now, they run simulations on the twin,
They crash the plane in the simulator first.
thousands of times. They can ask these specific, terrifying questions. What happens if interest rates hit 8% and simultaneously a cyber attack hits our Asian operations?
Wow.
They simulate the stress. If the digital twin survives, they proceed in the real world.
That's a game changer. It takes the gut feel out of risk appetite. You know exactly where your breaking point is.
It allows for dynamic risk appetite. You can actually take bigger risks in some areas if you simulated the downside and you know you can absorb it. It turns risk from a guessing game into a physics problem.
But this brings up the inevitable question. If we have robots monitoring everything and digital twins running simulations, what happens to the people? The report talks about the new machine, a hybrid workforce.
This is critical. Usually when we hear automation, we think of job losses. And to be fair, the old jobs, the manual box checking, the data entry, those are gone.
So what replaces them?
A role that requires what McKinsey calls orthogonal thinking.
Orthogonal thinking. Okay, that's a $5 phrase. Break that down for us.
It means thinking at right angles to the obvious. AI is brilliant at processing historical data and linear patterns. But it's terrible at imagining things that have never happened before.
The unknown unknowns.
Exactly. Orthogonal thinking is the ability to look at a data set and see a connection that makes no logical sense to a computer, but makes sense to a human who understands psychology or politics or history. It's about spotting those tail risks, the rare catastrophic events.
So the human is there to ask, wait a minute, does this actually make sense?
And to act as the ethics steward. This is huge. If an AI denies a loan, a human needs to understand why. Was the data biased? Is the model hallucinating? We need humans to interpret the black box of the AI.
So the human role elevates from processor to architect and judge.
Correct. And because the day-to-day grunt work is gone, the training has to change. You can't learn by doing anymore because the doing is automated.
Right. You don't learn to fly a plane by watching the autopilot.
So training becomes simulation-based. Just like pilots spend hours in flight simulators, risk managers will spend their time in risk simulators, handling virtual bank runs and cyber attacks. They build muscle memory for the crisis, not the routine.
I want to talk about how this changes the actual org chart. Because if you have these high-level thinkers and these complex bots, you can't just stick them in the old departments. The report proposes a new structure. 3 specific elements.
Yes, the old silos, where credit risk never talked to cyber risk. That's fatal in this new world. The new architecture is fluid. It starts with the strategic nerve center.
That sounds like the bridge of the Starship Enterprise.
It essentially is. This is the brain. It's a small, high-powered team of the institution's best thinkers. They connect the dots across all risk types. They set the risk appetite. They scan the horizon for those geopolitical threats. And they feed those insights down to the rest of the bank.
Okay, so the nerve center does the big picture thinking. Who does the actual work?
That would be the domain-specific pods. These are agile teams of deep experts. You might have a climate risk pod or a UK legal entity pod. They don't do routine monitoring. They handle the complex exceptions the bots can't figure out.
Or the problem solvers.
Exactly. And the third element,
The engine room.
the engine room. The Analytics Shared Center of Excellence, or COE, is where the data scientists and the engineers live. They build and maintain the models, the digital twins, the dashboards. It's a centralized utility that powers the other 2 groups.
So, the nerve center thinks, the pods solve, and the COE powers.
A very efficient summary. It allows for specialization, but keeps everyone connected.
Now, for the listeners who are sitting in leadership roles or want to be, specifically the chief risk officers, the CROs, the report has a pretty blunt action plan for them. It sounds like their job description is being torn up.
It is. The days of the CRO being just the chief no officer, the person who slams the brakes on everything, are over. The report outlines 3 mandates. First, upskill.
No more, I'm just a finance guy, I don't get the tech.
That excuse is a career ender. The CRO doesn't need to write code, but they must understand the capabilities and the limitations of AI. If they don't, they'll either block innovation out of fear or approve dangerous models out of ignorance.
Both are disastrous. What's the second mandate?
Talent strategy. Stop hiring just bankers and accountants. You need cognitive diversity. You need data scientists, sure, but you might also need a meteorologist for climate risk or a geopolitical analyst. You need that mix to get the orthogonal thinking we discussed.
And the third?
Responsible AI. The CRO must be the conscience of the machine. They need to establish the frameworks that ensure the bank's AI is fair, transparent, and compliant. They are the architects of the new system, not just the protectors of the old one.
I really like that distinction, architect versus protector. You have to build the house, not just guard the door.
And sometimes you have to be the business accelerator. That's a new hat for many risk officers. Using that digital twin to say, hey, we can actually afford to grow faster in this market because our simulations show we're safe. That is how risk becomes a competitive advantage, not just a cost center.
So let's zoom out. We've covered a lot of ground. We're looking at a world of 9x uncertainty governed by shadow banks and fragmented laws. We're seeing the death of the annual audit and the rise of the digital twin.
It is a total paradigm shift. We're moving from a reactive, periodic, check-the-box function to a proactive, continuous AI-driven nerve center.
And for you, the listener, the takeaway here is resilience.
Absolutely. In a volatile world, resilience is the ultimate alpha. The banks and the leaders who can predict the storm and simulate their survival will be the ones left standing. It's the difference between building a fortress that can't move and building a ship that can navigate rough waters.
I want to leave us with a final thought, something to chew on. We talked a lot about the human in the loop, the idea that AI handles 99% of the routine work and the human is there for the edge cases.
It's the standard reassurance. Don't worry, humans are still in charge.
Right. But here's my question. If the humans spend all their time looking at dashboard outputs from the AI and the AI handles the day-to-day grind, do the humans lose the instinct?
That is a profound risk.
The grind is often where intuition is born. You spot a bad loan because you've seen 1,000 good ones. If we stop doing the work, do we lose the ability to spot when the machine is wrong? And more importantly, if the AI is watching the world, who is watching the AI?
Who watches the watchers problem?
Exactly. Are we prepared for the moment the machine encounters a risk it wasn't trained to simulate? That's the question that might keep a few CROs up at night.
As it should.
That's it for this deep dive into the future of risk. Thanks for listening, and we'll catch you on the next one. Stay resilient out there.